keep it going. So thank you everyone for joining. What better thing to talk about on a Friday afternoon than debt? And we're lucky enough to have two very good presenters that know the SBA industry very well. My name's tbuckman. I own Tenaz Capital, which is a private equity firm, and I'll do a brief overview on what we do, and then we'll kick it over to Will McLean and Christopher McFadder to cover the SBA process, the ins and outs, and then most importantly, answer any questions you may have. So can someone just type in the chat box? I just want to make sure you can hear me. Okay, perfect. Perfect. All right. So here's an overview on Tenaz and just some of the things that we're working on. I've been in private equity for several years now, and I'm really focusing on ways that I can help people that individually want to buy and run a business themselves. And so what you've probably seen is information on a Tenaz immersion. And essentially what we're doing is taking a weekend and arming you with all the resources you would need to go out and buy a business and run it yourself. And whether that's the debt financing, which is what we're covering today, or you need an attorney, investors, deal flow, whatever that may be, we're trying to find ways to help you achieve that goal. So you can see kind of everything that's listed here on this box is one of those main aspects that you might need. So sourcing deals, covering due diligence, equity capital, and one of the most interesting things that I'm working on is trying to find a way to provide personal guarantee insurance. And so with all of these tools, I'm trying to find ways to make the acquisition process simpler. And we'll be hosting another immersion in the spring that will really cover everything, provide you with a network. Christopher will probably be there. We'll probably have an attorney there, and really just giving you everything you need. And so with that, one of the main topics that we're going to cover today is an SBA loan. I've used an SBA loan myself. You can't really beat the terms of it, being an individual acquirer. I've used different forms of debt in different deals that I've done, and nothing really compares to the flexibility of the SBA financing. So with that, I'm going to kick it over to Christopher.
All right, thanks very much. Good morning, everybody. Welcome, and thanks for taking the time to learn about SBA financing, and specifically too how HomeTrust Bank can help you get SBA financing for your business acquisitions. As Tim said, I'm the director of HomeTrust SBA Lending Division. Just a little on HomeTrust. So we're headquartered in Asheville, North Carolina, which many of you may know as Beer City. We have a ton of craft breweries, so we've been on the headlines lately. But HomeTrust has been around since 1926. And we're physically in North Carolina, South Carolina, Tennessee, and Virginia. We're about $3.5 billion in asset size, but as an SBA lender, we are a national lender and we have PLP status. I've personally been at the bank for 15 years and kind of experienced from the back room and operations, credit, and origination, commercial, residential, SBA. It's been a great bank. I'm just excited to be a part of it for that long and really help people connect to capital. Just a little bit on my team. So our SBA lending division, we did about $63 million in SBA originations last year. I personally did about $24.8 million, including a good bit of business acquisitions. And one thing that helps HomeTrust stand out, we'll talk a little bit more about this later, is goodwill doesn't necessarily scare us. A lot of SBA lenders are really looking for real estate deals, fully secured deals, and shy away from larger deals with goodwill. But, we like to think we're common sense lenders, and if it's a good business and a good story and we can hit all the marks, the goodwill doesn't scare us. That's what's great about the SBA program too, which we'll learn a little bit more about. It really allows for good terms to finance these business acquisitions. I'm going to hand it over to Will McLean, let him introduce himself from Windsor Advantage, and he'll dive into a little bit about the SBA program in general. Then we'll get back through some case studies. So, Will?
Great. Thanks, Christopher. Let me know if anybody can hear me, but Windsor Advantage, what we are basically is a consulting firm that has worked with about 90 banks throughout the country to start up and operate their SBA lending divisions. So over the last 9 or so years, we've processed more than $2.3 billion worth of SBA and USDA loans. We currently manage and service a portfolio of 1.4 billion, and kind of increasing every day. And what our main focus is trying to give banks that don't have the capital or don't have the personnel the ability to operate in both of these, SBA and USDA programs. And so when we're thinking about government guaranteed lending, there's a couple of different products that really dominate the picture, and those are the big ones. And so we work with all these banks to try and get them up and running, get them moving as quickly as they can, and really reduce their overhead costs. So the reason I'm here is that as we go through these transactions, I hope to bring kind of a other experience to the table on discussions around searchers, how they've operated, discussions around business acquisitions and some of the rules. If we took the volume that just our shop does every year, we would be a top 5 lender in the country. And so Christopher and I work very closely together on a regular basis. And we wanted to make sure that we got you guys the best resources we could. Personally, I've overseen about 1.5 billion in SBA 7A transactions, and a few more USDA as well. I work out of Chicago and run our front end and back end, and then we have offices in Indianapolis and Charleston as well. So what we really wanted to do is start by diving a little bit into kind of an overview of the SBA program. And so SBA has 2 main programs, the 7A and the 504. For the sake of conversation today, we're going to focus on the 7A program, primarily because the 504 is capital assets, right? It's a great program for real estate, for equipment, for other assets that you can, touch, feel, hold. But the 7A program is a little bit more flexible in terms of what you can use it for. So when we're talking business acquisitions, we're really focusing on that program. So to give you a little bit of background on how this program is developed, I think it's really interesting to see the growth year over year. So we're using fiscal year end 2018 numbers. We're about to come up on fiscal year end 2019. But if you look back in 2016 and even 2015, we've seen the program grow tremendously. In 2013, it was about 15 billion, and now we're closing in on that $30 billion mark. We'll probably be about 27 billion this year. So it's grown every single year, but what you've seen is a couple interesting concepts. So one, the number of lenders participating in the program has dropped every single year. And what that really means is more and more lenders are specializing in the product. And I think it's important to note to everybody on this phone that while you're going out there and you're looking at financing, a huge piece of this is going to be certainty of execution and making sure you're working with a lender who has that experience, understands the program, and understands what they can do is going to be a big advantage. And in a lot of instances may actually be worth looking at, pricing differences and things like that. So just as demonstration, there's about over 2,000 lenders that used to operate in the program. And then as of last year, it's 1,800. And then if you look at where we're trending this year, we're actually dropping down closer to 1,500. And so really what that says is the volume and the expertise is really consolidating in the top lenders. The same thing has happened in terms of volume. The top 50 lenders by volume in the last fiscal year did about 53%. If you look back 2 or 3 years ago, we were at closer to 49 or 50%. So all that means is just make sure you understand kind of the source of the information you're getting, who you're talking to on a regular basis, and that when you guys are looking for financing, you ensure that the individual that's talking to you on the other side really knows what they're doing. Okay. Next slide. So to start off, we just want to hit on a couple of really easy things. And so this is our attempt to try and simplify the eligibility concepts within the SBA program. It has about 400 pages worth of rules. And so certainly this is not everything. But when you're looking at prospects, there's some things to consider, right? So first and foremost, what we do is we try and break this down into 5 easy steps. And we do it from simplest to toughest, right? And so as you go across this page from guarantor to use of proceeds, you see a few more bullet points added. And frankly, there's more complexity behind each of those. I'll focus on a couple of things in each of them that you guys should think about. But really, from a guarantor perspective, what I want everybody to understand is that it's primarily for legal permanent residents and U.S. citizens. You have to have acceptable credit and no previous government defaults or losses. All right. The borrower side, you have to be buying a for-profit business. It has to be U.S. based, and the size standard, which I think is an important thing to note here, because we will get into some acquisitions that might be a little bit close to this line, is you need to be buying a business with less than $5 million of after-tax net income and less than $15 million of tangible net worth. Now, for the most part, considering our cap on loan size is about $5 million, most of the time you don't see a transaction above the $2.5 million of EBITDA. But keep that in mind as you're looking through these things and as you're thinking about SBA, not just as a tool for today, but as a tool for growth down the road. From an industry perspective, I'm not going to hit on a lot of these, but I think it's really important to understand that we're talking about active businesses here. So we're not talking about things like apartment buildings or any type of real estate investment assets. We're talking about operational businesses, things that you can go in and you can run and you can grow. Professional services are a great option, really asset light service style businesses. And then from a structure perspective, there's two main categories here. All loans are fully amortizing. You're going to require a personal guarantee, which I'll talk a little bit more about later. And they all have to be $5 million or less. But think about them in two main categories. Intangibles and goodwill, buying a business is going to be a 10-year term. And buying real estate is going to be a 25-year term. When you're looking at these transactions, you've got a combination. Make sure you talk to somebody early about understanding what that's going to mean for their particular credit box, and really expect that a seasoned SBA lender is going to provide you the maximum term that they're allowed to. All right. And then from a use of proceeds perspective, you can mix use of proceeds. And that's, I think, something that some people don't always think about. Business acquisitions obviously is what we're focused on today, but think about your working capital needs at close, if there's any real estate that you might need to acquire, equipment that you need to acquire, if there's some awkward debt on the balance sheet that maybe comes over through your transaction. All of those concepts are important, right? When you're talking about buying a business, you're not buying a business to keep it the way it was. You're buying a business to grow and expand it. And so make sure that when you're going into it, you think about those things before we go forward. All right, I'm going to hand it back to Christopher to dive a little bit more into advantages to borrow and some more about HomeTrust before we kind of dive in some details about acquisitions.
All right, thanks. I think we'll hit on a few of these, but wanted to focus on some real specific benefits of SBA loans, and especially if anyone out there's ever gotten a conventional loan, you'll recognize some of these. But the first is SBA really provides long-term, fully amortizing loans, so no balloons and no short maturity dates. And I'll give you an example, or really two examples. But typically, if you finance commercial real estate, the majority of those loans are structured. It might be a 20-year amortization, but with a 5-year balloon. So essentially, every 5 years, you need to come back in, renegotiate the loan terms with the bank. You probably have a rate change at that time, maybe some fees, a new appraisal, and things of that nature. And or the bank can just refuse to renew your loan. So at that point, you'd have to refinance it and move it and go somewhere else. And we see a lot of that too when banks actually change hands. The acquiring bank oftentimes just will flat out refuse to renew certain asset classes. And that's been a problem really in the last 10 years. So SBA is really good about that. You can't get in that situation because all of the SBA loans are fully amortizing, meaning they're full-term loans. By the time you get to the end of the term, your balance is zero. The longer amortization periods, as Will mentioned, real estate, you can typically go up to 25 years. On most commercial real estate, the average is probably between 15 to 20-year amortizations, depending on the bank. Brand new multifamily apartments, hotels, you might see 25-year AMs in the conventional space, but the overarching average is really probably 15 to 20-year AM. Goodwill, intangibles, 10-year maximum term and amortization, which is actually pretty significant. And I'll give an example here. We had a client, I financed conventionally their leverage buyout. They had a pretty hefty note, seller debt that came due, and the bank originally did that loan on a 4-year term. When we refinanced it, we did the debt consolidation and paid off the seller note, stretched it all back out over 10 years, and we saved the borrower really about $550,000 a year in cash flow, which was really material. That was, essentially a working capital injection, and they actually termed their revolving line of credit for the first time in the history of the company. Really, real significant cash flow differences. Let's see, lower collateral requirements. Again, SBA, they require collateral to the extent that it's there. So they have what's called fully secured guidelines, and we'll look at that a little bit deeper on some case examples coming up. But essentially, if there's not hard collateral, it's not a no for SBA. They may require things like life insurance and liens on primary residences. But if it's, a total goodwill, intangible deal, business acquisition, there's no, fixed assets or really collateral that you can liquidate, it's not a show killer. So no prepayment penalties for loans less than 15 years. That's actually significant too. Most conventional bank loans do have high prepayment penalties right now. Longer amortization, we talked about that in detail. Lower equity injection, a little bit here, and we'll see this further on. With business acquisitions, change of ownership, the SBA requires a 10% equity injection. On a conventional deal, that could be, really depending on the type of deal, that could be up to 25% equity, and again, with a shorter term. The other benefit with SBA, that 10% equity can be made up of 5% of seller financing if that seller financing is on full standby for the life of the loan. We'll go through some specific examples there. There's many different ways to structure the seller financing, and you can have multiple seller notes. So you could have some of it on full standby, some of it on repayment, and just kind of different layers and different structures. And the other benefit really is the government guarantee gives the lender benefit by allowing them to have a security for collateral shortfalls and longer term loans. So because there really is a collateral shortage on the majority of these loans, the lenders really look to the SBA guarantee as collateral, which is kind of what entices us to make these loans and feel comfortable. Because there's nothing to liquidate, but if something did go wrong, unfortunately, at least we'd have the guarantee to help kind of cover our risk. And that's the big thing that makes the program work. I want to hit real quick on the next slide, underwriting guidelines. And really, per the SBA, prudent lending standards govern the SBA 7A loan underwriting. The guarantee cannot be used to replace the reasonable credit judgment and prudent underwriting policies that would be used on similar size conventional loans by the lender. And what that really means is we've got to use common sense. We can't just do anything under the SBA program. The deals have to make sense. It's not a catch-all bucket. I just have to point that out. So we do have underwriting standards. SBA has what they call the SOP, and that's kind of their handbook or credit policy that we follow. And different banks have different kind of overlays to that depending on their risk appetite. And that may be an example of that is a bank, one of my BDOs joined us from, they actually required 20% equity on all business acquisitions. Well, HomeTrust, our bank, we really just follow the SOP in regards to equity. So if the deal cash flows and it makes sense, we're fine with just the minimum equity injection of 10%. So that's what I mean by different banks have different appetites. And it could be industry specific, it could be differences between real estate deals versus goodwill deals. But we try to follow the SOP fairly closely. And at HomeTrust, we're really looking for cash flow coverage just to make sure the borrower, the business, has the ability to repay. So if you're buying a successful business, it'll have the ability to repay. And that to us is just kind of the main thing we're looking for. Hey, can you repay? What's the history of the business? And that's the middle part of this slide, minimum borrower debt service coverage ratio. And before we dive into that, also want to point out there, another benefit with SBA lending is typically there's no financial covenants, so performance covenants. A lot of conventional loans will have what's called a debt service coverage ratio covenant. And what that means is each year when the bank's updating the financials from the borrower, they'll look and do an analysis, and they might say, hey, if you fall below a 1.3 debt service coverage ratio, your loan is in default. And then the bank has the right to call the loan. Well, with SBA, we can't put those debt service coverage ratio covenants into play. There's some specific covenants, like in regards to change of ownership and things of that nature, but there's no financial performance covenants that we can automatically trigger a loan default. And that's pretty beneficial. So HomeTrust,
if I can just inject for a second, just for anyone that doesn't really know what that means from an operating perspective. let's say, you buy your business and you're operating and all of a sudden you have some kind of hiccup, and they're always going to happen no matter what. If you use traditional financing and you trip one of these covenants, that's a really big deal, and it means the bank might call in a loan. And here with the SBA financing, as long as you're able to make your monthly payments, it's really not an issue. And that's just a very big key factor to consider when looking at the SBA financing.
Perfect. And, Tim's saying too, hiccups happen when we're underwriting and doing due diligence, and as you guys will be doing also when you're considering a business to buy, we look for a 1.5 or higher debt service coverage ratio. And what that typically is, it's the EBITDA or the adjusted EBITDA, if the adjustments make sense, divided by the annual debt service. And what that does, that's essentially allowing room for hiccups to happen. So if you buy a business, we made some adjustments to the cash flow because, for whatever reason, it could be you're forecasting a change in operating expenses, changes to salaries and wages, or forecasting something in your revenues to change. Well, if there is a hiccup and something goes wrong, you want to have a buffer to make sure you can basically handle the debt service comfortably and be in a safe spot. And that's why we look for that 1.5 debt service coverage ratio. A little bit more on financial covenants below. I think I talked about that a minute ago. Credit scores, we don't have a minimum credit score. We do try to target a 680 or higher beacon score, so the Equifax beacon. We do make exceptions to that. And again, part of that is what's the narrative, what's the story, but no hard and fast credit score, but we do target a 680. I think from there, let's go into a couple case studies if we can see how these kind of come into play. And what I've done, I've put 2 deals that we've actually financed recently just to walk through. So this first one, if you look at the sources and uses table, this is kind of where I like to start. If someone sends me a LOI or an offering memorandum, they're, hey, we're looking at buying this business. Here's the target purchase price. We can kind of look at it, come up with a structure, determine a rough idea on the working capital needs, and also back into the cash flow to make sure the proposed structure can support, and the business can support that cash flow, that debt service. So on the left side, the uses. So this subject business, they had a 6.3 purchase price, and that was really allocated $6 million in intangibles and $300,000 in fixed assets, so really equipment. Working capital need was about $600,000, and that's because the buyer of the business, they didn't negotiate AR. The seller was going to keep all the accounts receivable and cash on hand. So the buyer needed cash on the books immediately until they were able to generate and collect on the first cycle of accounts receivable. The SBA guarantee fee and the closing cost, and I wanted to point out on that guarantee fee, that's a function of the loan amount. SBA totally drives that and gets that. None of that goes to the bank, because that's a pretty common question, is can we cut the guarantee fee? But that's just part of the financing package that goes straight to SBA for them to guarantee the loan. So this one was an asset purchase of an existing service industry. Again, no AR was included. It was a liability-free purchase. So the seller was going to deliver the assets with no debt. Again, $6 million really in intangibles. So there was no hard collateral except for the $300,000 in fixed assets. So if you look on the sources side, we're looking at a $5 million SBA loan secured by really $300,000 in what we could liquidate. This loan is eligible for a 10-year, fully amortizing term. We actually structured this with a 5-month interest-only period, and then it went to principal and interest payments for the remaining 115 months. And that just to give, that gives an extra buffer as the new owners transition in. The payments are a little bit smaller up front, so they have time to stabilize and really start generating some accounts receivable. So in this case, before I get to those bottom 3 bullets, I think this is a good time to look at the sources side of the table, because this will make a little bit more sense talking about equity and the collateral shortfall. But we structured this with an SBA loan of $5 million. The borrower brought 5.14% equity. So that 5.14 is calculated on the total project cost because we had to include the closing costs and the working capital as part of the transaction. So the borrower brought $362,000 in. They're short. Remember, they need 10% total equity to qualify. So the seller was willing to hold a note for the 4.99%. So that's the difference to get the equity injection to 10%. That note's on full standby. It can't be repaid until the bank and SBA is paid back in full. And additionally, there was a second seller note, and that seller note would be in third lien position, but it was for $1,343,000, and that note did have repayment terms. In this case, that note was getting repaid. I think there was a 2-year interest-only period, then 8 years of principal and interest. So essentially here, there's a significant collateral shortfall. We put liens on the guarantor's primary residences, and they provided life insurance as 2 partners. So we got $2.5 million of life insurance on each. And really that seller note went a long way. So overall, the bank's only financing 70% of the total project, and then some real assistance from the seller. The next example, we'll switch slides. I think Will mentioned earlier, you can mix use of proceeds. So that previous example had working capital. This has a real estate purchase, business acquisition, and working capital. And again, the term is really driven by where the bulk of the proceeds go to. So in the prior example, it was primarily a goodwill intangible deal, so it was limited to a 10-year term. In this case, and I don't know if I put the term on here, if you look at the spread, about $240,000 went towards the real estate, $180,000 for the business acquisition, and then the rest of the soft cost. But actually, we do have it on here. This was a 25-year fully amortizing term loan. I think it was right at 50% of the proceeds were for the real estate. So, significant collateral shortfall at the end of the day, but we were able to get a full 25 years on the loan term, which really helped cash flow in this situation. So again, this was an asset purchase of a printing business and the associated real estate. There was no accounts receivable or current assets being purchased. That's why we threw in the working capital. In this case, the borrower really just didn't need a lot of working capital, so it was limited to $25,000. We did have a collateral shortfall, so we did get life insurance again in this case. And we also put a lien on actually 2 residences that the owner owned that had equity in them. So there was a seller note. In this case, if you look on that sources side, the bank financed 86% of the transaction. The borrower brought their minimum 5%. The seller agreed to hold actually a little over 8%, all of it on full standby, so no repayment until HomeTrust and the SBA was paid back. So in this case, that actually really helped the borrower. Some sellers would want to put just 5 on repayment and then get repaid on the 3 from the gate. But this was a great situation where the seller said, hey, I'll put the whole 8% on full standby for you. And we see that a lot. We see sellers really willing to negotiate on these seller notes, just trying to get a deal done and help. And then, just being flexible and keep in mind when you look at different deals, it's okay to have multiple seller notes. I think the most I've seen on a transaction is probably 4 different breakdowns, and that's probably getting a little excessive. But 2 separate seller notes is pretty common. Let's see. I think on the next slide, just kind of a quick eligibility review process. I wanted to point this out, and I'll hand it back over to Will just to talk through some real specifics on structure, rules, and seller financing. But when you guys are considering a deal, if you can get the best thing you can do, if there's an offering memorandum, they're called different things, from different brokers. But typically, any kind of investment deck, offering memorandum, pitch books, get that to us. We can look at that business, especially if the documentation in that early due diligence package, if it's got cash flows and a breakdown of the price and the assets included, we can really turn that in 24 to 48 hours, review it, see if it's going to be eligible for SBA financing based on the size standards, some of the other things Will mentioned. pull together that sources and use table that we just looked at on the prior two slides, try to determine kind of the working capital need, the minimum equity injection amounts, but also we can take the cash flows from that pitch deck and make sure the proposed, deal with cash flow at an acceptable level. Because if you know that sooner than later, you can start negotiating the seller note in your favor from day one instead of having to go back down the road. So again, and my contact info is on this slide. I think Tim's going to pass this slide out, or I'm sorry, the presentation out to everyone, but he'll provide my contact info and Will's info. But feel free, email us if you want to just pick up the phone and call us, talk through a scenario. Just get us the information. We're happy to pull together a sources and uses table and get right back to you so you can keep on looking at the deal and trying to negotiate. And we may get into a little more of that to come. But right now, I'll hand it back to Will for a little more detail on SBA valuations, seller notes, etc.
Great. And then a couple things just before we kind of continue. There is a Q&A section at the end that we're going to go through. If you guys have questions and you want to submit them, opening up all the lines might get a little bit loud and kind of tough to deal with. So if you can, maybe shoot them into the Q&A tool that you've got. And what Tim's going to do is kind of put them all together, make sure that we get to the ones that that aren't redundant and that don't overlap. We'll make sure we hit on all those items. Obviously, the process as we go through this, some things will pique your interest, or you might have a question about a certain concept. Just throw it in there, and we'll make sure we get to it. And then the same concept applies. What we're going to be doing is putting out polls, and part of the polls is really just to get an understanding of what we should be focusing on when we go through this conversation. So I think Tim is probably going to be sending out a poll here shortly about whether people are also currently looking for debt. And that really helps us focus on debt versus structure. There you go. Here it is. And so just, make sure that your questions go in. We'll make sure we answer all of them. And then, as we go through them, we'll make sure we open up your line so that we can have that discussion if there's some more follow-ups from there. Cool. And as going through this next section, what I want to really harp on is a couple things. So we're going to talk about specific structures and rules in the SBA space. And so let's keep in mind that while I'm sure a lot of people on this conversation have a good idea of what they're looking for, how they want to look at financials, all these types of things, this is really here to give you an idea of how an SBA lender is going to look at a lot of these items. So when we start, we always talk about the valuation. One of the big things we've seen is a trend lately, and this is partially because of improving economics and economies and really, frankly, market for sale of businesses. We've seen multiples go up a bit. And so I want to talk through real quickly how to do a rough, dirty SBA valuation, so you get a good idea of, hey, is this financeable or not? One of the things required in any SBA transaction with goodwill is going to be a third-party business valuation, and those third-party groups are not actually allowed to use a lot of the typical kind of projected cash flow models that you might see if you were to go to a smaller boutique investment bank or something like that to get the valuation done. What they actually use is historical numbers, and then they basically give a flat growth rate of 3% year over year on a go forward. So what that really means is when you're looking at these businesses, your future growth is not what drives the value. It's what your historical numbers show. So quickly going through it, lenders are typically going to use EBITDA as a basis, right? So straight normal EBITDA on a cash value or cash basis. And then they're going to do a seller discretionary earnings add back. And so those add backs typically include a few basic items, owner's comp, discretionary expenses, and other items. There's also going to be a few market adjustments. But the reason I always talk to people about getting to this number is because this is really what's going to drive two things. One, what's going to drive cash flow, right? So really all you're going to do out of this is net out what your draw might be, and now you've got your business cash flow. And then two, what drives your business valuation. And so when you're going through negotiation, and this is why we always recommend people talk to lenders early, is before you really dive in and have a full-fledged LOI in place, understanding what you think you can and cannot get done is hugely important, right? Nobody wants to have to go back and renegotiate an LOI 3 times just to get to that level. So knowing what you can offer, knowing what you think you can get financed, and really being aware of the fact that these numbers all vary based on lender and based on what they'll accept is super important. So That's how you get to your basic seller discretionary earnings. But here are some examples of what a lot of lenders will accept. So small businesses account for things in very different ways. I have even seen somebody try and buy a business with $25,000 worth of expenses that they added back, and when asked why they added back, the seller said because that's my family's beauty salon expenses for the year. So it really kind of comes from all different ways. When we talk about common add backs, right? Common add backs are going to be owner's personal expenses like health insurance, family cell phone plan, personal automobile, things that typically people put into a business. Travel and entertainment expenses, while a lot of them are business travel, a lot of them will still put that in there. And then transaction and legal or consulting expenses for a sale. And so while once it's completed, a lot of things can be capitalized when you're selling your business. A lot of times they'll expense those. And so those might be one-time expenses that adjust your EBITDA number in a very massive way that could change your whole offer. Same concept goes for excess rent. If the seller owns the building, they put as much back there as they want, and at the end of the day, you're going to adjust it back to market rate. So some things to keep in mind: a valuation may adjust what the bank agrees to, because there are some market trends, or there might be some numbers that they believe are accurate or shouldn't be allowed. So it's not always going to be a one-for-one relationship. And then fair market value does not consider synergies, right? And so when we talk about this program, what I really like to talk about is it's great for your first acquisition. It's also great for your second, third, and fourth. It's a program that allows you to continually borrow through it as long as your total outstanding balance of 7A loans is $5 million or less. So if you bought a smaller, maybe a $500,000 EBITDA company for about $1.5 million, you have the ability to continue to borrow and add on to that company through expanding through acquisition. So the concept there is, right, as you expand through acquisition, you get a lot of benefits on the expense side of consolidating items. What the business valuations never include is your ability to consolidate expenses or create synergies through multiple different acquisitions. And then just keep this in the back of your head too. Most SBA lenders are going to use cash financials, not accrual financials, for their analysis and for their breakdown. It's just a standard within the industry when we're talking about low to no collateral transactions. They're going to look at these as if cash flow is the number one asset on their books. Okay. So a little bit about multiples, right? And this kind of goes back to the statement earlier when I said that future cash flows are less considered in the SBA space than historical. And so really, what are we looking at? Well, multiples are driven off of obviously the industry, what the normal concepts are there, how efficient the business is, and what are the revenue stream characteristics. So I'm bringing an example here. We've seen a lot of people kind of do DSOs and other concepts where they're consolidating dentist offices. It becomes a little tough with the SBA for some other reasons that we'll talk about later, but it's a hugely popular user of SBA financing. So as an example, the average multiple range on a dentist is 1.5 to 2.25, right? So much lower than a lot of people would think right off the bat. Why is that? In a lot of instances, you're talking about an individual that drives most of the revenue. So you have the one dentist or maybe two dentists, but the more dentists you have, the closer you are to that 2.25 mark. The industry average margin is another big driver for this. And so the same concepts will come into play with whatever you're looking at. If you're above industry average margins, you're going to be in a positive situation where you're at the higher end of the multiple. If you're below, you're going to be in a lower. And then, in this case, it's how many active patients does the practice serve? So more variation as opposed to higher ticket kind of concepts. So maybe cosmetic dentistry versus a group that's more focused on traditional dentistry. And what are their uniques, right? So all of those will go into shifting you on the scale. But what I really like to talk to people about is if you're looking at an industry or a specific industry, really understand what national valuation groups are going to use as your multiple range. And if you're really focused on one industry, talk to Christopher, talk to myself. We can get you an indication of where that should be. That way you're looking in the right margin. You know that, hey, maybe my offer needs to be, let's say, $4 million. Make sure I don't go much above that.
I might be.
So it's a really good way to baseline your initial offer and really talk through it.
Well, I might be losing you a little bit. You went a little bit robotic on me.
Going in and out.
Mm-hmm.
Yeah. We might have lost you. But I guess I'll start with questions while we wait for Will to get his sound to work. Oh, there you are. Yep.
Me okay? Okay. All right.
You're kind of coming in and out.
No. Okay. All right. Let me try.
Now you're clear.
No, I'm clear.
Yep.
All right. All right. I'll continue through here, and then just shoot me a message, or Tim, just interrupt me if you stop hearing me. I won't stop talking. Okay. So I want to dig into seller notes. So Christopher mentioned a couple times that seller notes are a huge part of SBA financing. Typically, when I talk to somebody who's looking for a business the first time, we tell people to target approximately a 75% senior debt tranche, right, from an SBA lender, 10 to 15% seller note, and 10 to 15% equity, depending on how you break it down. Why? Because generally, if it falls within a reliable EBITDA multiple or STE multiple, you're in a place where you have good, strong cash flows that a lot of lenders will look at. And what everybody here should be thinking about is making sure that they, are able to structure a deal that's financeable, right? The big piece here that the SBA focuses on is cash flow. And so when we've got these higher multiple deals, you really tighten yourself up when you put in low equity amounts or bring in low seller notes, or at least short-term seller notes. So thinking about how you structure a transaction can make a huge difference, really night and day, on how financeable it is. So seller notes, very common in the SBA space. And I know there's at least one question out there about seller notes and how we can do some certain things, and we'll hit those in the Q&A section. But as a reminder, there is a 10% minimum equity threshold for the total project on every single transaction. And so to get there, there are really two ways. One, bring cash or equity in some capacity. Or two, use a seller note to make up a piece of that. So a seller note on full standby with no payments until the SBA loan is retired can account for up to half of your required 10%, so up to 5% of that. Now, it can't account for overpayment. It's a separate conversation. So if your valuation comes in well lower than your purchase price, that seller note doesn't count as equity then. But in order to reduce the amount of cash needed to bring up front, it's a great tool. The bank also is able to dictate terms. I know there's a lot of conversations out there, and historically there were more about having certain requirements surrounding what a seller note says and what the terms are for it to be SBA eligible. The reality of it is that the bank, if they can get comfortable with your structure, is allowed to approve really any structure on that seller note as far as cash flows, amortization, and liens. So a seller can take a lien behind the bank, and they can be repaid as early as the day one, as long as they're subordinate. Okay. And then one other piece, and this is a piece that I'll kind of hit on now, and I'm sure we'll go deeper into. In a lot of business acquisitions, people are looking for ways to do two things. One, protect yourself from downside risk, and two, provide the seller with some benefits over and above that you don't necessarily have to pay for today. Things like earnouts, residual payments, whatever it might be. The SBA has pretty much put the kibosh on a lot of that type of activity. What they have explicitly allowed, and DC, kind of the rule makers, have signed off on, are seller notes that perhaps change or reduce based on certain performance triggers. So a great example would be if you had, $1 million acquisition, you had a $100,000 seller note, and your statement was that if EBITDA falls below, or if revenue falls below, depending on what metric you guys can agree on, let's say 300,000, the seller note will kind of reduce by 50K. Just a way to protect you from losing clients. Anytime we talk about these businesses, we're talking about generally under 2.5 million of EBITDA, and a lot of times owners have very close relationships with clients. As soon as that's broken, right? How do you make sure you retain your value? And so that's a good way to protect the downside risk of it. It is not a way to protect upside risk. Keep that in mind. The SBA will not allow you to do that to grow the seller note past the value of the business, but it is a great way for you guys to protect yourself when you're going through the acquisition. Okay. And then other important concepts. And so seller involvement is one big thing that comes up a lot. And this is why I mentioned kind of on the dental side, why that program doesn't work great for the SBA. But sellers must not own any of the business after the sale. So think about this as a complete acquisition. Any owner on day one cannot be an owner post transaction. All right. They also can help for transaction. You can consult and have an agreement in place for up to 12 months, but they cannot hold any key positions in the business going forward. What I will say is that the rule says key positions, but the SBA's interpretation and what they put out there is even kind of more stringent than that. They really believe that a seller's involvement should stop after that 12 months transition. And after that, they do not want an official agreement in place. All right. In situations where the seller comes back later and it really helps with the business, the SBA can be more comfortable. But just know that in place at close, an agreement of 12 months and no longer should be the expectation. Okay. And I want to hit on personal guarantees a little bit. It's a big concept in the SBA space. Any owners of 20% or more must guarantee, and those are joint and several. So just because you have a 50% partner does not mean that each of you are only guaranteeing 50% alone. Everybody guarantees the whole amount. Now, the function of that, we can talk about a little bit if some people have some desire for that. But at the end of the day, the concept is they're joint and several. And then any key employees with ownership of less than 20% may also be considered. So a great example here is in really, you have a CEO or somebody who's running the day-to-day operations and you decide to give them 15%. The SBA may look at that and say, well, that's clearly the person who is the driving force behind the day-to-day, so we're going to ask for their guarantee as well. And then generally a guarantor, because these transactions are not heavy in assets, will need to pledge available equity in any real estate owned. Now, the strict rule is that it's 25% or more equity available in personal residence or any rental properties. And that's what I would expect each of you to assume your lender is going to follow, right? That's the way HomeTrust operates. That's how the way other lenders out in the market operate. If somebody steps outside of that, that's likely an exception to what they normally do. Okay. Because the SBA requires them to take these, it does not require them to take it with less than 25% equity. And then a couple of other recommendations I want to put out there for people. I think it's really important to understand how important a good, strong, detailed LOI up front helps move that process. Anytime you're buying a business from a seller, realize that it's generally their baby, right? It's the one they started, they've operated, and they've produced, and they've continued with. So in situations like that, changing terms gives them an opportunity to rethink whether or not they want to sell it. And so I have seen transactions die over season tickets to maybe the worst Bulls team I've ever heard of. Just because the seller then had the opportunity to say, well, if we're renegotiating this, let's renegotiate the whole transaction. So LOIs up front, think about things like your working capital levels. Think about things like the details that you need in your seller note, all that kind of stuff, which is why we think it's so important that when you guys are going into this, you think about the financing partner they're going to use so that you make sure that if they've got some requests, they can bring them to you early. If they look at the cash flow and they say, hey, you wanted a 3-year seller note, it really would work better at a 5. You're not bringing it back. You're not trying to get them to convince them later. You're bringing it straight forward right up front and showing them that breakdown. And then expect a process, and I don't just mean the financing process. I mean your due diligence process, your negotiation process for the final purchase agreement, all the other items that go along with this. There really are a lot of moving parts. Expect it to take 90 days, right? And so what that generally means is ask for an exclusivity for 90 to 120. It's relatively standard. A lot of people will look at it, and if you show good kind of availability up front, you put in a good price, and frankly, if you talk to a lender early and submit an LOI with something like a term sheet or some type of offer based on initial financials, you really get some good, strong kind of ground to stand on to ask for that kind of timing. But it's really important to use your time and go through your diligence properly, and that's usually the timeline it takes. And then Don't include any earnouts or future bonuses. Don't even mention them. Don't bring them up. Anytime somebody hears it, they kind of hook onto it. And so when you're going into these negotiations, knowing that you're using SBA funds or planning on using SBA funds, keep that out of the conversation entirely. And then engage an attorney on your behalf to help with diligence. Typically, this doesn't happen with guys that are really kind of going into a deep search for a business, but I've seen a lot of people wait a little too long. And when they get into it, they've submitted an LOI and they start kind of going through the machinations of a purchase agreement negotiation. It's really important to have an advocate on your side that knows the legality of things, first and foremost, and is able to help protect you from things like liabilities. One of the big pieces we see a lot is sellers will push for stock acquisitions for tax reasons, as for other reasons, making sure that there's a good reason for why you're doing that you're protecting yourself properly, that you're keeping the liabilities at bay is a huge piece to it. So make sure you're comfortable with your attorney, hire a good one, and work with them through the diligence process. All right. So that's what I wanted to talk about today. Well, good. Tim?
Speaking of attorneys, one of the future calls and webinars that we might host like this will include a legal aspect of buying a business yourself, and we'll have an attorney speak there.
Great. So I wanted to go into Q&A now. I know we've got a handful of questions out here. Tim, is there like an order you want us to go in for these?
If we just go in the order that they came in, that should be fine.
Okay, cool. So then I'm just going to read them off, and then Christopher or I will take each one of these, or obviously Tim will take it if it makes sense. The first one we see is, have you seen any pushback from sellers on holding a note and being on standby for the life of the loan? And why would they do something like this? In these situations, we have seen some pushback, but typically what you'll end up seeing is, because it is such a small portion of the value, it may be a situation where you want to adjust your offer. And so, as opposed to giving them an offer for $4 million, maybe you give them an offer for $4,050,000, right? And it really kind of comes down to 5% of the total transaction on full standby, still owed and still offered. How do you make that structure a little bit nicer so that you can bring less cash? So it's really about, what's your premium that you put on your personal liquidity, or frankly, access to funds? And if it's a situation where maybe you don't have access to a full 10%, but you can buy a business that you really like the metrics on and you really think are valuable, it's a situation where you might update your purchase price a bit to make sure you take care of that.
It also depends on the seller and their advisor. I've had situations where they don't push at all on that, and situations where that's all they care about, making sure it's not on standby at all. So it's going to vary deal by deal.
Yep. Yeah. It's become more and more common though, and I think as people understand, and they have advisors that let them know that it really is a situation where SBA financing is kind of the key to getting it done, you'll see people accept it more and more. Okay. Can transactions fees be paid out of the SBA loan, including diligence fees to the borrower? So diligence fees to the borrower. So we'll hit that on a second. But in general, transaction fees are going to be included in your total project costs. So when you look at any of the sources and uses tables, what you'll see is the acquisition, working capital, fees, and closing costs all built in. When lenders are looking at their kind of, we'll call it loan to cost ratios, they're going to be using the total project and not just the acquisition. So when I say 75% of your project could be SBA financing, typically that will include your closing costs. That being said, diligence fees to the borrower is a slightly different concept, okay? So if this is a reference to fees for searching and finding the transaction, that's typically not going to be an eligible fee for you. But if this is fees that you've racked up searching and doing diligence on it, things like attorneys, things like paying for networking or whatever other fees you might have for your offices over the time, all of that could potentially be included as part of the project. Okay. Are non-bank closing costs legal, allowed in the formal sources and uses table? Simply put, can these closing costs be financing? Yeah, so in the same concept, right? Portions of it will, right? When you look at the total, the capital stack, usually what that ends up meaning is that for every dollar of equity you put in, you can finance in some capacity through seller, 15% seller financing and 75% SBA, about $9 of costs and things like that. And so it'll be split, but it's really looked at as a total project and really kind of utilized in that manner. Okay. Is amortization straight line or mortgage style? So it's a bit of a combo conversation, right? So amortization on this is really going to be basically reset every year. And so it's not mortgage style in that your payment really doesn't move at all. It's mortgage style in that you pay the same amount and it's applied to interest first and then principal. And then it adjusts based on changes in payment days and changes in interest rate once a year. And so it's always going to go interest first and then principal second. But you will in real life see your payment adjust at least once a year by every lender in the country, if not more, to adjust for maybe your payment was supposed to be pulled on a Saturday, but because Saturday the bank wasn't operating, they pull it on a Monday. So you'll see some changes in that. So it's not strictly, easy to look at, but when you're doing your cash flows on it, right, if you're using Excel for it, your simple payment function will suffice without having to make any changes to it. And from an accrual methodology perspective, if anybody's really into that to that conversation, you should expect actual over 365 or 30 over 360. You're not going to see actual over 360 in the SBA space very often. Okay. Special programs for veterans. So I'll let Christopher kind of hit on this from a HomeTrust perspective. But what I think everybody should understand is that the SBA has historically had support for veterans in a lot of different programs, and they do continue to have some support for veterans in the SBA space. However, those are typically small dollar amount loans. So before, if you came and you borrowed a $5 million transaction, you would be able to actually reduce your guarantee fee by half. And that guarantee fee is substantial. It's about 2.7% of the transaction. But in a situation now where they've reduced some of the veterans advantage concepts, they now only allow it on express or very small loans, 350 and under, and that actually reduces your upfront guarantee fee entirely. But once again, a lot of the transactions that I'm sure the groups here are looking at are not going to be $350,000 from a financing perspective, but that's where you really get the most advantage. Christopher, do you guys have any programs internally that help that support?
Yeah, what we did previously too, when in regards to like the reduced guarantee fee, we would also reduce the packaging fee or waive packaging fee and some of the processing and closing fees. So we still actively do that at HomeTrust. So essentially, some reduced closing cost benefit for veterans.
Okay. And then assuming the business purchased is in a different geography, this would necessitate a full move by the buyer, his or her family. How would the underwriter view the buyer moving, selling their home, no collateral, and the spouse? Okay, good question. So transitions in life and lifestyles and all those things happen during a lot of these acquisitions. The way you typically will look at a situation with the SBA and how they're going to treat specifically collateral. If you own a home now and you are looking to transition over time, maybe it's not an immediate move, maybe you are moving over time. The lender will typically take a lien if the equity is available on the home you own now. And when you look to sell, they'll basically just hold the equity for you on your behalf when you sell until you find your new location, let you use your equity for that, and then take a lien behind your initial mortgage as well. And then spouse leaving job and change in income, a lot of that is going to be more based on, what the expectations are for you going forward. So if your spouse is leaving a job altogether, or if they think they might get a similar job or they continue to work, that's going to be part of the global conversation. What I'll tell everybody here to focus on primarily is business and then personal. Most instances, a spouse is not going to also be considered a guarantor unless they have an ownership percentage in the business. And so when underwriting, while spousal income is helpful, if your relative liabilities are somewhat low, you guys keep a good credit profile, they're going to just assume that you pull enough from the new business to support your lifestyle. and that'll help provide kind of your cash flow basis. So when you're really looking at it, I would say still focus on the business and focus on a personal draw that allows you to make the changes in lifestyle that you need to. So, your seller discretionary earnings might end up being 190, but or let's say 500 for the sake of this conversation, but you really need 150,000 to cover the debt, your expenses at home, mortgages, whatever might happen. Model that in as part of your draw. That's the way they're typically going to look at it.
Yeah, I'll chime in there too. And the bank just reasonably wants to make sure you can cover your, personal debt obligations and living expenses and taxes. So we do a calculation, based on how many dependents you have in your income level, and then we obviously throw in any kind of debt from your credit report for living expenses too. So we want to make sure, typically we look at like a 1.2 coverage, so personal income to living expenses and personal debt, but we can make exceptions, but that's kind of the threshold you want to cover, cover your obligations and your living expenses by a little margin. Great.
All right. And then how much equity do you typically require from a searcher themselves, whether it's raised from other funds or from them in particular? I think a good point on this really is, who you're talking to. What I would say is that when we deal with our lenders, the groups that operate in this space, we probably have about 10 that consider transactions in this space. Across the board, most of them are going to look at primarily whether or not you have the liquidity for it. And so if you have some, they're going to want some of that in there. It doesn't have to be every dollar you own. It doesn't have to be every dime you've ever made. But if you've got some money to be able to put in, they'd like to see that put in. And then the rest, as long as it comes from investors that are properly allocated or brought in, is typically going to be fine. Like I know Christopher has had kind of both situations happen, and their bank has been able to be comfortable with both, where an individual brought most of the equity or alternative sources did. It's got to be equity. It's got to be proper, proper equity that doesn't have to be repaid, depending on how you structure your ownership or what's going on with the investors. There are some instances, though, and this is, I think, where the bigger concern is going to be. If you don't personally have the liquidity to invest, a substantial sum, and you really are going out to find equity, be wary of the fact that ownership percentage is going to be heavily targeted as a concept for whether or not somebody has to guarantee, right? And so giving somebody a large portion of ownership, and when I'm talking large, I'm talking about really 15% or more, is going to be something that brings in at least the discussion as to whether that group, fund, individual, family, friend, otherwise, may need to guarantee or be part of the transaction. But yeah, it's going to be a little bit hit or miss depending on most banks. But if you're talking to a bank who's comfortable with this type of group, right, that we're talking to on the phone right now, generally they're not going to be too insistent on where that equity comes from.
Okay. And I'll say too, HomeTrust, we don't have a hard and fast rule on that. We have gone, both ways, but a lot of it too is what's the story. Just trying to understand, does it make sense? But we're probably more to the little equity camp. As long as the equity gets in and it makes sense, we're pretty flexible. So just wanted to point that out.
Cool. And then some sellers and brokers are aware of the SBA. Yeah, this is a great one. So I think sellers, brokers, and borrowers all are wary of the SBA, understanding the process, the timeline, and how document heavy it can be. What I will say is this is where I harp once again on this concept of saying make sure you're with a good, reputable, strong SBA lender. And really, that's going to be anybody that clearly knows the rules, that's able to provide you the right structure, that can give you some background on how they process things. There are two camps in this world. There's the PLP camp, which people like to talk about a lot, and then there's general program. What I would advise everybody here to understand is that while PLP is a designation that a lender earns, it's not always a designation that's that hard to earn. And just because somebody's a PLP does not mean they're going to use it. And frankly, in a lot of high kind of or low collateral situations or high airball transactions, lenders will use the general program and go through and get SBA approval regardless. So just be cognizant of the fact that just because a lender says, hey, I'm experienced, I'm a PLP, that doesn't necessarily mean they're strong. but there are some really good lenders out there, right? Christopher's a great example of one who really knows their credit box and what they're doing. And that's the biggest piece. If the lender can get comfortable and provide you an internal approval quickly and efficiently, that gives you the best indication of how quickly they get through the rest of it. Because while the SBA is there to agree to the transaction, they're not generally there to make a credit decision, but rather an eligibility decision. And so that good, clean, early lender who's able to provide you that information, like an early LOI or like a early commitment, would be a huge advantage, and usually is the ones we recommend people target for transactions like these.
And I want to weigh in there too. You know, HomeTrust, we really look at the deal and the credit risk and the different characteristics of each deal. So one $5 million deal, we may take GP, and the next we may go PLP. So it really depends on the deal itself. But we've had deals go GP, and we've been actually, like, I think 35 days and less close. We've had PLP deals go a really long time. But part of that really is just getting a really good package. So, you know, if the seller's cooperating and the borrower's providing what we need and we can get our questions answered, if we're on top of it, you know, we try to turn these as quick as possible, be responsive, and get it through. But a lot of it, too, depends kind of on the other end. Sometimes it's hard to get the financials we need from a seller. So really pushing the seller, you know, sometimes their CPA to get what we need to get our questions answered goes a long way. If we get good info in, we get pretty quick turn times.
Yep. Perfect. It really is a big kind of document game. And so if you guys are on top of things and your seller's on top of things, the process can go really smoothly. All right. Well, that's all the questions we have right now. I don't know, Tim, if you've got anything more you want to add, but I just want to kind of reharp on the concept of, you know, reach out to either of us, Christopher or myself, if you've got any questions on things, early stage, late stage, wherever you are. We'd be happy to have a discussion with you, help you out with things, make sure that you're comfortable with what's going forward, with what you've got out on the table. And certainly, you know, if there's a need from a financing perspective, HomeTrust is a great option to kind of get you guys there as well.
Yeah, and I'll just add, I have spoken with several different banks when I've been looking for financing on my different deals, and I found HomeTrust to be the most, probably the best partner out of all of them, and that's why I wanted to include them on this call. And as we look to host more of these, if there are any topics that will be helpful for us to cover, please send me a message, and we'll get it done. Thank you all for taking the time, and really thank you, Will and Christopher, for putting this on for us.
Yeah, we appreciate it. If we can help in any way, just feel free to call us, email us, and we'll try to help you get across the finish line.
All right. Thank you, everybody.
Appreciate it. Bye.